Hi, I'm Billy Gwaltney, and this is the CYA Podcast. This show is for the physician who understands the importance of protecting everything you've worked so hard to achieve. Each week, I'll bring you tips and advice to help you cut through the clutter and misinformation and show you exactly what you need to preserve your income and way of life. If you're ready to achieve the peace of mind that only financial security can bring, let's get started. Welcome to today's episode of the Cover Your Assets podcast. This is Billy Gwaltney, and as always, I'm really happy to be with you today. In this episode, we're going to cover my initial conversation with a non-surgical specialty. So it could be a pediatrician, could be a hospitalist, an oncologist, any number of specialties that generally are not invasive from a procedure standpoint. And so the time is spent in clinic and kind of moving around and making evaluations and so forth. And so we're going to make a few assumptions here, which I want to make clear. One is that you're still in training. The other, it could be residency or fellowship. The other assumption is that you have requested and received a spreadsheet from me that shows the discounted rates with the top companies. And you're at the point of kind of wanting to understand more of what you're looking at. What are the terms? What does it all mean? You may have some idea of what it means. You may have done some research, read a blog, done a Google search, or talked to a colleague, but you're kind of at the point of wanting to hear it for yourself and how this translates to what kind of coverage you should have. And so generally when I'm on a phone call with a trainee who, again, is a non-surgeon, I start by saying, okay, tell me, what are your key questions? I'd love to answer those in as much detail as you'd like, and then just see where we go from there. And the most common question I get when I ask that is, can you walk me through the spreadsheet? What does it all mean? And so the purpose of this episode is not to replace that individual conversation with you, but to give you at least an option to start learning more about what these terms mean, maybe during some downtime on a night shift or just some off the grid time when you're thinking to begin that process of exploring maybe a dreaded process, but hopefully it won't be too dreadful. So again, I would be happy to answer additional questions. I'm going to go through, we're going to assume that you have the spreadsheet in front of you. And what I kind of do is just start from the top and walk my way through. Okay. And this is about a 25 to 30-minute conversation. Okay. Just to give you an idea. I start out with a quick background of who I am. My specialty, I guess you could say, is disability coverage. I say that because it's what I do morning, noon, and night. For some reason, I love it. I'm not sure exactly why, but I do. I work with close to 2,000 physicians across the country. I would say the vast majority of those are trainees when we start working with them, and they move everywhere. You ladies and gentlemen move all over the world. So we have clients in Australia, Asia, Europe, South America, obviously the States, and so all over the place. And I love that. So my focus is specialty on occupation disability coverage for physicians. And I'm an independent broker, which means no insurance company pays my rent or my light bill. And I don't answer to them other than just using them as an option when we're talking about coverage options for you and for all of our clients. This is being recorded in spring of 22. And so all of our clients are looking at the same four columns and companies that you are seeing if you have the spreadsheet. That is Mass Mutual, Emeritus, Guardian, and Principal. I don't work for any of these companies. They're on the spreadsheet because they perform. They're on there because of contract language. So don't think that because you want to pick a company that you've heard of or that maybe advertises on TV or that seems familiar, because that doesn't mean you're going to get paid if you're disabled. All that drives a claim being paid is contract language. Okay. And so that's what we're going to talk about. Obviously, the company status is important. Their financial ratings matters to a certain degree, but all of these companies have been around longer than any bank we use. They're rated higher probably than any bank we use. They've probably been around 100. I think the youngest one is like 125 years old. And so they know what they're doing. And they're really solid. So you're fine picking any of these, okay? So why these four? These four are on here because they're the only four that are going to have no moving parts and provide the definitions that you want over the course of your career. If you ever had to file a claim, these are going to be the ones that you would want to have. Outside of these, it gets muddy pretty quick. Most independent brokers can probably access 70 or 75 insurance companies. The 4 are on the spreadsheet because they're the only 4. There used to be 6, there used to be 5, and now there are 4. So depending on the blog post you read or the Google search you do, there may be a couple others mentioned. But Mass Mutual, Emeritus, Guardian, and Principal. Stick with those. I'd love to work with you, but whoever you work with, make sure that you have one of these. They're the best of the best. All 4 of these are what's called non-cancelable and guaranteed renewable, which means that the policy can never be canceled, the definitions can never be changed, and the rate can never be changed. And that's important. It's vital to have no moving parts, as I mentioned, so that when you go to increase coverage, you're getting the same thing as when you started, and they can never change the terms on you or cancel it. So what we do here at this point is, as I said, start at the top of the spreadsheet and work our way down. These companies will allow trainees to purchase $5,000 a month of coverage, which is why we put these examples there. This benefit is non-taxed. So if someone has $5,000 a month, becomes disabled, they can spend all $5,000. You wouldn't owe the government, state or federal, any of that benefit. There's no law or rule that says you have to start at $5,000. So on most spreadsheets, we include at least one option for $2,500. So you can see the linear relationship between the cost and the benefit. And that would be perhaps more appealing to someone who still has a number of years left in training. And it's wise to consider you don't have to do all or nothing. Clients that say, hey, I want to take care of this. I want to check this box. I want to get some coverage, but I can't afford $5,000 a month. Just can't do it. So what can I do? Well, we say, okay, well, maybe start at $2,500. You take care of the medical screening that is once forever. So once you're in, you're good to go. You don't have to update that in the future. Also, lock in the discount so that you'll never lose that. Some of these companies have a 30% discount. That's significant. There's an opportunity to get a 45% discount. That's significant. So start low, lock in that discount, and then you keep that discount not only on the initial $2,500, but on anything you increase to in the future, which we'll talk about. You can increase once you become an attending. And so you can pretty much check that box of getting your coverage and start at a lower amount and keep the cost more budget friendly. Obviously, if you're disabled in the meantime, you get less benefit. So there's a risk with that. But most people understand that. And so it's just an option, food for thought, something to consider. Most of our clients do start at $5,000, but we have a good number that still start out a little bit lower, at least initially. The elimination period is either 90 or 180 days, depending on the situation. You pick that up front. That's the length of time that you self-insure from the date of a disability until the first check shows up. Okay, so if you're disabled on January 1st and you have a 90-day elimination period, you get the first check in April. And if you have a 180-day elimination, you get your first check in July. So the longer you're willing to wait, the lower the cost. The benefit period is pretty customary to age 65. You could get a benefit period to age 67 or 70. It costs more for that. Pretty much all of our clients pick 65, but you certainly have the option to pick another one if you want it. But that's why we put 65 on the spreadsheet. The definition of disability, this is what starts to separate these 4 options from everyone else. And I want to address this specifically for non-surgical or non-invasive specialties. True specialty on occupation, that definition means 2 things. One, first, it means that if an illness or injury prevents you from performing the material duties of your specific occupation, then you're totally disabled. And 2, there's no penalty for income you later earn doing a different job. Okay, so if you are in clinic and you cannot do clinic, then you are disabled. You could then go teach or consult, do telemedicine, write a book, whatever you want to do, make an unlimited income doing that, and there's no penalty to your benefit. And I have some clients that say, well, is this definition that important if I'm not a surgeon? If I cut off my hand, then I can still do clinic. So do I need the true specialty definition? Well, that's an excellent question. The answer is yes, because the vast majority of claims are illnesses, not injuries. Over 90% of claims for private disability insurance are illnesses. So most of our clients, whether they're surgeons or not, are not chopping off their hand. Most people tend to think, or a lot of people tend to think, hey, if I'm a quadriplegic or if I'm in a bad car accident, and those things certainly happen. I'm not saying they don't happen, but the vast majority of disabilities are illnesses, musculoskeletal, soft tissue diseases, and those kinds of things. So let's say you have a herniated disc in your back, okay, and you can't get out of bed. And your job up until that point your employer expects you to show up at clinic physically. Part of that is you getting in your car, going to work, moving around a doctor's office or a hospital if you're a hospitalist, and physically showing up and being able to see go from patient to patient to patient. And you're paid in a lot of cases based on how productive you are during your time in clinic. But you can't do clinic now. You can't get out of bed. So the question is, are you disabled? That's literally the $1 million question. Well, with these 4 contracts, what they're going to do at the time of claim is actually interview you, talk to your employer, tell us about a typical day for you. What do you do? How does it start? Do you physically show up to clinic? What are your duties? What are your requirements? How are you functioning? They verify that through the CPT codes for patients that see you, and those are your duties. Okay. If you can't do those duties, that one of those duties, a significant and kind of a driver for those duties is you physically showing up to work, then if you have a herniated disc in your back and you can't go to work, then you would be considered disabled. Totally disabled. You could then, so you'd collect your full benefit. You could then stay home and do telemedicine or consult, or like I said, write a book, do whatever you want to do, make an unlimited income doing that, and there's no penalty to your benefit. Okay. The reason I'm addressing this to non-surgeons is to say the herniated disc in the back, the majority of claims, the musculoskeletal soft tissue diseases, they're going to affect the income of both the surgeon and the non-surgeon. Okay. In the days of production-driven pay, surgeons get paid for procedures, non-surgeons get paid for clinic, and it's production-driven, typically. Okay, now there can be exceptions to that. I recognize that. But most people are being paid based on productivity. At some point, if you can't show up at work, your paycheck is going to be impacted. Okay. And so having coverage that is going to classify you as being totally disabled because you can't show up to clinic is vital. Because outside of these 4, what group policies do, what association policies do, what some of these others do that are just really bad, they market it as specialty specific and own occupation. But what they mean by that is very different than what we just discussed. Okay. If you are an oncologist and you are board certified internal medicine and you're doing oncology, you have a significant training background. Okay. And a Google search of MD duties or physician duties may reveal you're qualified to do 50 duties. Okay. But over the course of your career as an oncologist, you've streamlined what you're doing to a half dozen or so duties that you do over and over and over again. Okay. And so literally the $1 million question is, if you're disabled, what is the threshold for being disabled? Being unable to do 50 duties or unable to do a half dozen duties? You're going to want it to be half dozen. Okay. You're going to want that to be the threshold. Okay. And with the 4 on the spreadsheet, if you can't do those half dozen, then you're disabled. You could then go do one of the 45 other duties you've been trained to do and had exposure doing, and that would be considered a separate occupation. Okay. What other policies are going to do, what the specialty specific group policy or employer is going to do that benefits has just told you is the best thing ever, they don't know this necessarily. They're not lying to you. They just don't understand it. That at time of claim, what they typically mean by your duty threshold is the 50. Okay, so they're going to say, hey, yeah, we understand you can't do the material parts of these half dozen that you were doing, but you know what? There's a lot of other duties you're qualified to do, so go figure out how to do those, and you're not totally disabled. So it's literally like night and day. And so we do have clients on claim. And they get paid. And we've had a number of situations where They collect from their private policy as they expect to, and they never see a nickel from their employer policy. Okay. They don't meet the definition of disability. Any reasonable person would say they're disabled. They have a herniated disc in their back. They can't get out of bed. They can't go anywhere, but they're not disabled because they could do telemedicine. They could do, COVID proved it, right? You can do virtual visits. You can do that now. So go figure out how to do that, and we're not going to pay you. What these four are going to do is not penalize you because you learned how to do virtual visits during COVID, but you're not doing them when you're disabled because you're showing up physically at clinic. And so the devil is in the details for this, and being non-surgical. I can't say this enough. Please, please, please. I'd love to work with you, but maybe I'm annoying you at being so over the top about this. I don't mean to be, but if you find another broker that's not so over the top, at least get your private coverage, make it with one of these four, because trying to navigate a claim without private coverage, without the best private coverage, is really painful. It's not going to go well. It's going to be muddy. It's going to be contentious. You may even talk them into paying you for a while, and then you get a letter saying they're not going to pay you anymore because you need to file an appeal with the Social Security Administration. I mean, it's just complicated. And so hopefully that makes sense. I'm sorry to belabor that point, but it's really important. Next on the spreadsheet is what's called the total future insurability. This is what allows you to expand or increase your coverage as your income goes up as an attending. So as you graduate, you become an attending, your income increases. Most of our clients want to increase their coverage. And when you do that, there's a formula that companies use to calculate how much coverage you can qualify for. Depending on your specialty, and if you're looking at a spreadsheet, the cap is either $20,000 or $30,000, depending on the company. Each company comes up with that individual or separate from each other, and they run that number. They won't give you $20,000 just because you're willing to pay for it. Okay. They really don't want you overinsured if they can help it, believe it or not. And so we run those numbers to determine how much more coverage you're eligible for. Let's say that when you start, you have $5,000 a month and you're eligible for $10,000 a month. Well, you bump up to $10,000, and then that extra $10,000, let's say you have a total insurability of $20,000, the $10,000 that you haven't used yet stays available for you to use as your career continues to grow. And most of our clients do. They hit productivity, they make partner, whatever it is, their career tends to expand, their income expands, and they want to increase coverage down the road. What's important about having this on your policy is that you access the trainee discount on everything you increase to up to the cap of $20,000 or $30,000. Okay, that's significant. We'll talk more about those in a minute. The other thing is that the medical screening that you do initially, which is easier for trainees, we'll talk about that in a minute as well. You do that once forever. So when you go to increase in the future, you don't have to be as healthy then as you were when you started. They don't ask you any medical questions. And so it's like flipping a switch. It's really easy to do. There is essentially a linear relationship between the cost and the benefit. Okay. From a budgeting standpoint, it means that if you triple your coverage, you're going to triple the cost-ish. Okay. Because there'd be an adjustment. If you're 30 when you buy it initially and you're 40 when you do an increase, the cost for the part that you're buying at age 40 has a higher per unit cost than what you did at age 30. And that's obvious, but both of those purchases would include the same trainee discount. Okay. So it's essentially linear. There are exceptions. Emeritus currently, the way they do their future insurability is when you go to increase in the future, the per unit cost is going to be lower at higher coverage amounts. And so if the rates are in the same ballpark for $5,000, emeritus is pretty much always going to be the least expensive at $15,000 or $20,000. Just something to think about. They're also you may see on the spreadsheet, every 3 years in parentheses in the future insurability column. That means these companies require you to increase every 3 years, or at least go through the exercise of calculating how much more coverage you qualify for every 3 years. They have a rule that you need to accept at least 50% of what you're eligible for, or they remove that increase rider from the policy. Okay. Now, most people are ready for an increase about every 3 years, if not sooner. And so that's generally not been an issue, but it is some guardrails, I guess you could say, around how they calculate it. Now, there are certain triggering events like graduation or changing jobs where you would not have to wait 3 years. So if you buy your policy and a year later you're graduating and become an attending, you don't have to wait 2 more years to increase. You can increase right away. But generally over the course of your attending career, you would just expect to kind of update that calculation every 3 years. And your broker's supposed to help you with that. We're in touch with our clients. We help them do that as they need it and make sure that they don't forget. The next on the spreadsheet is residual benefit or enhanced residual benefit. This is for partial disabilities. It pays if you can do your specific duties part-time but not full-time as the result of illness or injury. It's important to have. There's a minimum income or time percentage loss that's required to activate the benefit. It's either 15 or 20%. Lower is better. 20% is really good. It's the industry average. It's just that Mass Mutual, Emeritus, and Guardian have stepped it up to 15%. So something to factor in. Next is the long-term recovery benefit. This is vital. It pays if you medically recover from a disability and return to work, but your income does not recover to what it used to be. And that happens a lot. We have a family doctor client who has collected for, I think, 12 years from a recovery benefit, was out for like 2 years because of a stroke, came back, medically cleared to go back, just not as productive as he used to be. His practice evaporated. He started over. He used to see 25 patients a day. Now he sees 18 or whatever. So it's very possible in the days of production-driven pay to never reach the pre-disability level of income. And if you get outside of these top-tier contracts, that's not present on an association policy, on an employer policy, and you would be painful to live without it. So you definitely want to make sure that's there. Next would be the psychiatric benefit. That pays for benefits for illnesses related to drug addiction, alcohol addiction, depression, and anxiety. Okay, Guardian could potentially pay benefits for that to age 65. That's what they're known for, and that's there if you want it. Emeritus would pay for up to 5 years. It could be 2 years, depending on your specialty. And Mass Mutual and Principal would pay for 2 years. Mass Mutual is 2 years per occurrence. Principal is 2 years. They do offer a to age 65 psychiatric benefit. We don't have hardly any clients that pick Principal for that. That would change their discount and their rate. But generally, if you're looking at Principal, it'll say 2 years. If you want the to age 65, I would recommend Guardian. We've not seen a claim go beyond 2 years for psychiatric disabilities, but obviously that's anecdotal. It doesn't mean it couldn't. One of the catches, I mentioned the streamlined medical screening. I'll cover that in more detail later. But if someone has been or is currently being treated for even mild anxiety or ADHD or depression, then they're going to very likely exclude the psychiatric benefit from the policy as a pre-existing condition. So just something to think about. Next on the spreadsheet is the presumptive benefit. That pays if certain events happen. They're going to presume that you're totally disabled and pay your full benefit anyway. And those events are loss of eyesight, loss of speech, loss of hearing, or loss of use of both arms or both legs or one arm and one leg. And this would pay if you wanted to continue working. So let's say you lost your hearing and you wanted to continue working. They're going to go ahead and presume you're totally disabled and pay your full benefit anyway. Okay. It doesn't mean that so Principal requires that in that example, your hearing loss would need to be permanent in order to pay. Okay. The other three do not require permanent, and Emeritus would waive the elimination period and pay you immediately. Okay. Now, I want to clarify. Principal is not saying that, hey, if you have a hearing loss and you can't work, it has to be permanent to get benefits. That's not true. What this is, if you have a hearing loss and you can't work, then you're disabled and you would collect. Okay. The presumptive benefit is that if you have a hearing loss and you wanted to continue working, they would require it to be permanent in order to pay then. Okay. So just clarification. We can talk about that in more detail. I realize that might be tough to be clear on in the brief time we've covered it here, but it's an extra benefit. Okay. It's just something they offer in addition to fully covering you for any illness or injury with the true on-occupation definition of disability. This is an extra benefit. Okay. The presumptive benefit. Emeritus offers a couple of perks that I want to mention that a lot of clients like. You don't pay extra for them. They give them to everybody in most states. They're not approved in all states, but most states. Probably, I think, like 46 or 47 states. Non-disabling injury benefit, they'll pay 50% of the base policy benefit up to a cap of $3,000 towards any medical treatment for minor injuries. Okay. So if you ever hurt yourself, it doesn't have to be work related. You hurt yourself hiking or working out, skiing, whatever, get stitches, x-rays, MRIs, surgery even, they're going to pay you the medical cost of that treatment, even if you have no out of pocket. Okay. So you can make a profit on your injury. That is very probably likely. There's no limit to the number of occurrences. They can't raise your rate. They can't exclude the injured area. There's no downside to it. They just offer it as a perk. And a lot of clients like it. I've got a client that's collected 3 times or 4 times from it. So it's very possible to use that more than once. Another perk is what's called a good health benefit. That is a perk where every year somebody has a policy with emeritus and is not disabled, which is how they define good health. They're going to drop the elimination period by 2 days. Okay, so that's going to add up. In 15 years, you would have a 60-day elimination instead of a 90-day, for example. So you get an extra check and you get paid sooner. An actuary would say that that's significant statistically. So again, just food for thought. The last row before the premium section is the cost of living adjustment or COLA rider. This is an inflation factor that increases your benefit while you're disabled to offset inflation. It's not required to have it. So we show rates with it and without it. But if it's on your policy and you had $5,000 a month, become disabled, they're going to pay that for 1 year for 12 months. And then in the 13th month, they're going to bump it up by 3%. And they keep doing that each year you're on claim for as long as you're on claim. It's significant. It would add up. Most of our younger clients tend to gravitate to that, but it's not required. Okay. So I don't spend very little time trying to talk anybody into that. It's more of just something to factor in. And so the rates at the bottom reflect each company's discounted rates with and without the cost of living. Each company has their own discounts, and these discounts are driven by a company's desire for growth much more than they're driven by the quality of their contract. Okay, so if you're looking at a more expensive option, it's likely because they have a smaller discount, not because their policy's better. Okay, so you can pay more if you want, but that doesn't mean you're getting more value. It just means that they have a smaller discount. Or they've classified your specialty in a different occupation class or a less favorable occupation class. Each company has their own actuarial department that determines where each specialty gets priced. And so that factors into the rate as well. With emeritus, you'll see 2 sets of numbers. Typically, the more expensive number is their discounted rate, and that's non-cancelable and guaranteed renewable, and the rate can never be increased. Obviously, if you increase coverage, the rate goes up, but otherwise it could never be increased. The less expensive number is what's called guaranteed renewable only, which is an additional 15% or so discount that they offer in exchange for them being able to increase the rate by occupation class in the future. And now, in the almost 60 years they've been selling policies, they've never raised the rate on anybody, any physician occupation. So their track record is perfect. So it's a very small risk. It is a little bit of a risk. We have a lot of clients that like it as a way to save more money. We have a good number of clients that don't. They don't want to give anybody a chance to mess with their rate. And so it's not for everybody. It's at least something, though, that you ought to know about. The streamlined medical screening I want to cover, it is easier for trainees because they waive the insurance physical. You don't have to see a nurse or see your doctor or get the labs done. They're still medically screening you. They're just doing it over the phone. So if and when you're ready, let us know which one you want. I would email you a DocuSign link to put in your personal information. It's like an intake form. You do that electronically, take you maybe 8 to 10 minutes. Then you would e-sign an application electronically, and then you do a phone call with an underwriter where they go over your medical history. They have, 20, 25 medical questions they ask everybody that they go through, and that's it for you. From start to finish, the process can take anywhere from 1 week to 8 weeks. So it can take a little while depending on if they need to get medical records to verify details. But your involvement in that process is less than a half hour, and it's all remote. So it's never been this easy to get coverage. And again, once you do that, if you have the future insurability on your policy, which we help our clients get, then you would never have to update that screening in the future. That's an important factor. I think all these points are important. The last thing that I do get asked a lot is, okay, Billy, I'd love to work with you. How do you get paid? And that's an excellent question. Your broker gets paid a small fee or small percentage of the premium you pay for the life of the policy. Okay. So you don't pay me anything extra. Don't ever pay your broker anything extra. The premium is fixed. The rates you see on the spreadsheet reflect that commission or fee that's paid to the broker. And if you go direct, the insurance company would send you to me or someone like me because that fee has to be paid. There has to be a broker on the application. So it's not cheaper if you call Mass Mutual Direct. The point in that broker being paid over the long term is to incentivize me or him or her to try to keep you happy. Your broker does matter. You need to make your broker earn their keep. This part where you're learning about the details and confirming that your coverage has the definitions that you want them to have or that you want the coverage to have, that it should have, navigating the medical screening, making sure you're getting the best offer. And if you're healthy-ish, these would be your rates. So the rate's not negotiable based on your health typically. If you're healthy-ish, these are going to be the rates. They do reserve the right to decline. Okay, so that's another, I've done topics on the medical screening part, which please check those. But in terms of your broker being compensated, make them earn that because you want to see everything in writing. I mentioned earlier, the devil is in the details. If it's not in writing, it doesn't exist. Don't take your broker's word for it. Have them send you the quote summary, the policy. You need to see the details. Now, they can send you the quote summary when you apply. The policy would be sent once you're approved and everything should match up. Okay. And take as much time and request as many conversations as you need to feel comfortable with what you have. That's what your broker gets paid for. We help our clients with everything from changing their address to increasing coverage, running those numbers to determine how much you're eligible for, how to do that, answering questions at that point. And then also advocating at the time of claim. We do, like I said, we have clients on claim. But for HIPAA reasons, obviously they're going to deal with you directly, but your broker can be as involved as you want him or her to be. We have our clients where we offer, and they've all taken us up on it, to sign an extra authorization allowing me to speak with the claims people on their behalf and just make sure that they're being advocated for, make sure that things are moving along the way they're supposed to. These companies are excellent at claim time. Okay. They really are good at this, the best of the best. But sometimes things get lost in translation. And we've had people on filing claims not communicate something the way it was supposed to. We were able to speak with the claims people and confirm the accuracy of what the situation was, and it moved the needle. It let the claim get processed a lot quicker, and it was favorable to the insured. So your broker should be involved. This is where it gets complicated. If you've dealt with an 800 number or online quote engine or whatever, trying to make it as people-less as possible on the purchase end, just remember that on the claim side of it, that's going to be the situation again, right? If you don't know who your broker is, if you've not had a conversation with them, then you're not going to have a conversation with them when you become disabled. So just factor that in. Your broker matters. And now I'm not a claims person. Okay. So I don't approve claims, but we certainly know these people and they know us, and that's important. They like us. That's a good thing too. So it does matter. We're set up to work with I may have mentioned this earlier, close to 2,000 physicians all over the world, mostly in the US, obviously, but you folks move everywhere, which I love. And so we have clients all over the globe. And so we're set up to help with that process and keep them up to date everywhere they go. And that's important. So your broker does matter. I hope you have found this helpful. Again, this is not meant to replace a detailed conversation. Please feel free to text me to arrange that conversation or with any additional questions. My number is 704-270-2376. Again, that's 704-270-2376. Would be happy to discuss your situation. Until we meet again, this is Billy Gwaltney. Thank you as always for your time.
This is the podcastfactory.com.